Welcome to the Coin Bureau Weekly News Roundup. My name is Guy.
And my name is Jessica. Here are the top stories in crypto this week.
Crypto gets rejected. Coins and tokens tumble in response to a supposedly hawkish Fed and the latest round of Tether FUD. When will the market pump or dump?
Ethereum's inflation returns, ETH supply turns positive after JP Morgan turns negative, and whales send millions in ETH to exchanges. What does this mean for ETH?
Coin and Base. Crypto's second largest exchange is revealed as holding 5% of all BTC, while its base chain surpasses Solana and teases a token. Why this is a bigger deal than you might think.
Record capital flight. China sees its largest outflows in almost a decade as the economy collapses and the yuan weakens. How this could foreshadow a crypto crackdown.
And a closer look at last week's top performing cryptos and where they could be headed next.
All this and more in just a moment.
Last week, the crypto market experienced another de facto pump and dump. That's because the market was rallying leading up to the Fed's press conference and started to crash shortly afterwards. What's interesting is that the Fed's press conference probably wasn't the catalyst for the crash. That's because crypto prices appeared to rally while Chairman Jerome Powell was speaking. Now this was interesting because the stock markets were simultaneously crashing. So this just underscores the fact that the crypto market has been a lot less correlated to the stock market in recent months. This relative lack of correlation therefore means that it's probably a crypto-specific factor that moved the market rather than a macro factor. The top candidate in this regard is a report by the Wall Street Journal, which claimed that Tether had issued billions of dollars in loans to unspecified business partners. For context, Tether once loaned hundreds of millions of dollars to crypto exchange Bitfinex, its sister company. Naturally, this loan was issued to cover a shortfall. Bitfinex had reportedly lost access to hundreds of millions in funds. US regulators subsequently fined Tether and Bitfinex for this shenanigan. As such, the news that Tether was once again lending billions of dollars likely led many crypto investors to believe that another big crypto entity may be short on cash, probably an offshore exchange. This would explain why the crypto market started to crash shortly after the report was published. Now, the catch is that this report may not be accurate. According to Tether CTO Paolo Arduino, the Tether spokesperson cited by the Wall Street Journal is not a spokesperson and doesn't work at Tether. Paolo also highlighted the fact that Tether currently has over $3 billion in excess reserves. He also claimed that Tether is on track to make over $4 billion in profit, not revenue, profit, by the end of the year. This makes sense considering that most of the USDT in circulation is backed by US government debt, which in some cases is earning a yield of over 5%. 5% on tens of billions is a lot. And I'll tell you what else is a lot, and that's 40 grand, which is something that you can get with all the airdrops and promotions offered by the Coin Bureau deals page. The link will be down in the description. Now, as is often the case, Paolo's clarification didn't get as much coverage as the initial hit piece. This is probably a part of why the crypto market hasn't recovered after the dip. Another potential reason is the absence of any bullish news to take crypto prices higher. The result is that prices are static. And if you're wondering why BTC's price seems to be stuck around 26.5k, the answer is the 50-month moving average, which is currently sitting at around 26.6k. Similarly to the Bollinger Band moving average on the weekly, the 50-month moving average appears to be a key zone of resistance and support for BTC. Logically then, falling below these levels could mean quite a sharp drop, and many crypto media outlets have speculated about this outcome. By the same token, however, bouncing from these levels could mean a continuation of the rally we've seen since the start of the year. As always, it's a bit of a toss-up. Now, if you've been keeping up with our weekly crypto reviews, however, you'll know that we've been speculating about the possibility that ETH has been leading the crypto market as of late. If this is the case, then the downside scenario seems more likely given how weak ETH has been against BTC lately. As reported by CoinDesk, ETH recently hit a 14-month low against BTC. This is likely due to the sell pressure ETH has been experiencing, including from some of its key players. Ethereum creator Vitalik Buterin reportedly sent almost $500,000 of ETH to exchanges last week, presumably to sell. At the same time, ETH whales have been sending tens of millions of dollars of ETH to exchanges almost every day, and you'll know this if you're watching blockchain analytics tools like Whale Alert. The fact that some ICO-era Ethereum wallets are starting to move ETH around could also be a cause for concern. Meanwhile, ETH itself has started becoming inflationary again. For reference, a portion of all ETH fees are burned, meaning that if there's enough activity on Ethereum, ETH is deflationary. This deflation is a tailwind for ETH because if its supply is declining, while demand stays the same or increases, prices rise. This dynamic is no longer in play, and it's something we predicted in our Ethereum update a few months back. Data from Into the Block suggests that ETH's return to inflation is due to an almost 10% decline in transaction volume over the last week. So, this begs the question of what caused this sharp decline. The answer could be that Ethereum is starting to fall out of favor with institutional investors. This is something that crypto asset manager CoinShares has noticed in its institutional flows over the last few weeks, and it seems we finally have an answer about why institutions seem to be shunning ETH. According to JP Morgan, Ethereum's activity after the Shanghai upgrade, which enabled ETH staking withdrawals, has been, quote, disappointing. The analysis cited the decline in DeFi activity as one of the reasons, and noted that regulatory uncertainty in the United States could be hurting Ethereum's ecosystem. Now, this is an understatement given that there's been extreme regulatory scrutiny of both DeFi and stablecoins as of late, and not just in the United States. Some of you may have heard that Binance is planning to delist stablecoins in Europe due to the EU's recently passed crypto regulations. From our perspective, though, there is a more fundamental reason why ETH has fallen out of favour with institutions, and it's one we noted in our video about the US government's debt ceiling deal. In short, ETH staking yields are competing with yields from US government debt, which continue to rise. Now, it stands to reason that institutions would rather earn 5% from investing in US government debt than from staking ETH. That's because the former is the safest asset in the world, whereas the latter is arguably one of the most speculative. It doesn't help that ETH's status as an asset is uncertain, at least in the US. Come to think of it, the large amounts of ETH we've seen sent to exchanges over the last few weeks could be coming mainly from such institutional investors. This would explain why these flows have increased along with bond yields, and it suggests these flows will accelerate if bond yields keep rising. If this is the case, then ETH could continue to see weakness until bond yields start to fall, and bond yields probably won't start to fall until there's a recession of some kind. Right now, most investors aren't pricing in a recession, but the few who are believe it could happen later this year or early next year. Early next year is when the next Bitcoin halving is expected to occur, and roughly when Bitcoin dominance is expected to start declining again. Given these facts, it's possible that ETH will continue to decline for the next 6 months or so. The silver lining is that this presents an accumulation opportunity. But back to Bitcoin. A recent report by Arkham Intelligence suggests that crypto exchange Coinbase holds around 5% of the BTC in existence. To put things into perspective, that's roughly 1 million BTC, which is worth around $25 billion. Coinbase itself owns around 10,000 BTC, worth $200 million. Now, this news comes hot on the heels of another big milestone for Coinbase. Base, its recently launched Layer 2 for Ethereum, now holds more total value locked than Solana. According to L2Beat, Base has also become the third largest Layer 2 by total value locked, though it has a way to go to reach second place. In any case, if you watched our Base tutorial, you'll know that we speculated about the possibility that Base could airdrop a token to its early users. Lo and behold, Coinbase's chief legal officer, Paul Greywell, recently remarked that a Base token has, quote, not been entirely ruled out. Paul added that a Base token could, quote, be viable at some point in the future. This makes sense given that Base plans on decentralizing, and this will likely require a token of some kind. Of course, the only thing standing in the way of this token is probably the SEC. You just know it would crack down in a heartbeat. And in other Coinbase-related news, the exchange is reportedly looking to acquire FTX's European arm. This is not surprising given that Coinbase has made lots of acquisitions over the last couple of years as part of its global expansion. Even so, it suggests that Coinbase is continuing to grow despite the bear market. By contrast, Coinbase's biggest competitors have been shrinking due to the unprecedented regulatory scrutiny they've been facing. It seems that Coinbase has been positioning itself to capitalize on their troubles, and this is more significant than you might think. For those unfamiliar, one of the reasons why the SEC is hesitant to approve a spot Bitcoin ETF is because most of BTC's trading volume is taking place on so-called offshore exchanges. But as these offshore exchanges face ever more scrutiny, BTC's trading volume is moving onshore, so to speak. Obviously, Coinbase is the primary onshore exchange. It's a publicly traded company that's been vetted by the SEC, which is a bit ironic given the recent lawsuit filed by the SEC against the exchange. Coinbase also has the backing of some of the biggest players in TradFi, such as BlackRock, which is using Coinbase as part of its spot Bitcoin ETF application. This is what makes the recent headlines about Coinbase so fascinating. Perhaps it's just us, but almost all these headlines have been very bullish for the exchange. It's almost as if we're being primed for some offshore exchanges to go down and for Coinbase to take their place. Now, even if this isn't the case, it seems perhaps inevitable given the circumstances. The good news is that Coinbase gaining dominance means that TradFi will be more comfortable investing in crypto, and we could even get a spot Bitcoin ETF finally approved. This means that many coins and tokens will see new all-time highs. The bad news is that the process by which Coinbase gains dominance is likely to do damage to the crypto market in the short term. Coinbase also appears to be closely aligned with TradFi interests, and you'll know this if you watched yesterday's video about the war to control Bitcoin. Regardless, the next few months are going to be very interesting for crypto, and not just because of what's been going on in the industry itself. If you've been keeping up with the channel, you'll know one of the key themes we've been covering is crypto's role in geopolitics. And one of the countries we've been focusing on in that regard is China. If you watched our video about the new governor of China's central bank, you'll know that he appears to have been behind the country's crypto crackdowns. That's because part of his job is to prevent capital flight. This is why the recent news that Chinese capital flight is at its highest level in almost a decade is so important. Some crypto analysts believe that this is bullish for crypto since it can be used to aid capital flight. However, we believe this could be bearish, and there seems to be evidence of this already. As some of you may have heard, Hong Kong's central bank recently put out a warning to crypto exchanges using banking terminology. Now, this was strange given that the administrative state had been embracing crypto to the point that it was reportedly forcing banks to accept crypto clients. Just a few days later, Hong Kong regulators announced that they would be tightening crypto regulations due to fraud allegedly committed by an unlicensed crypto exchange called JPEX. And as a cherry on top, Hong Kong regulators announced they would be releasing stablecoin regulations next year. When you remember that Hong Kong has basically been under China's direct control since 2020, you realize that there could be more to its anti-crypto pivot. Recall that even the crypto media acknowledged that Hong Kong's positive crypto stance was approved by China. It stands to reason then that it works the other way. In case you haven't put two and two together, crypto's use in capital flight is probably a part of why Hong Kong has suddenly started tightening its grip on the industry. It's possible that using crypto for capital flight via Hong Kong has started to increase since exchanges started serving retail traders. FYI, exchanges in Hong Kong started serving retail traders late last month. Since that time, the Chinese yuan has weakened against the US dollar. From the perspective of a capital flight cop like the PBOC's Pan Gongsheng, correlation and causation are one and the same. All possible exits must be closed. Now, the good news is that a crypto crackdown in Hong Kong probably wouldn't do much direct damage to the crypto market or industry. The bad news is that the narrative of the next bull market beginning in Asia could become less likely, and this alone could weigh on crypto prices and sentiment. For what it's worth, though, there are many other emerging crypto hubs in Asia, such as Singapore, which would keep the Asian crypto bull market catalyst alive. Having been to Singapore recently, I can confirm that the sentiment in the East is as bullish as ever. More about that in the description. Let's just hope that that isn't some kind of contrarian indicator. So, with all that said, let's now turn to the top performing cryptos. Jessica, take it away.
Thanks, Guy. Last week's top performing cryptos were Chainlink, Immutable X, Curve Finance, Terra Classic, and Zilliqa. Starting with Chainlink. Link's price appears to have pumped because of the launch of its cross-chain interoperability protocol, or CCIP, on Arbitrum, Ethereum's largest layer 2. Chainlink also hosted an exclusive event for TradFi institutions, which saw almost 200 attendees. As impressive as the recent pump has been, Link continues to trade sideways on the weekly and doesn't seem to be trending up or down. In fact, Link's price has been bouncing around $6 to $7 for almost 18 months. In the absence of any big crypto catalyst, the sideways chop will probably continue. Next up, we have Immutable X, whose IMX token appears to have pumped because of the crypto project's participation in a Japanese crypto gaming conference. Immutable also offered its first Learn to Earn campaign with $8,500 USD in rewards. Unfortunately, IMX continues to be in a long-term downtrend and was rejected at the Bollinger Band moving average on the weekly chart. The Bollinger Band squeeze suggests that volatility is imminent. The direction of this volatility ultimately depends on the catalyst that triggers the squeeze. When it comes to Curve Finance, CRV pumped for unknown reasons. It's possible this pump was caused by a short squeeze or an unknown whale coming in to save CRV tokens from potential sell pressure. CRV was recently sold OTC by founder Michael Egorov for 40 cents a pop. As you can see, CRV's price briefly fell below 40 cents, leading to fears that OTC participants would sell their stash. Fortunately for Curve Finance, CRV quickly pumped after breaching 40 cents. However, the long-term downtrend suggests this recent pump could be short-lived. Regarding Terra Classic's Lunk coin, it appears to have pumped because of a proposal passed by the Terra Classic community to stop minting the USTC stablecoin. It's hoping that stopping the minting will allow USTC to regain its dollar peg. USTC is currently worth just over a cent. The passing of this proposal managed to give Lunk its first green week in 2 months, but it didn't manage to reverse its continued long-term downtrend. If I'm not mistaken, preventing USTC mints could be detrimental to Lunk because USTC burns will increase its supply and suppress its price. Be careful. Finally, we have Zilliqa's Zil coin, which appears to have pumped because of the crypto project's recent partnership with Google Cloud. The partnership will see Google Cloud becoming a node operator on Zilliqa's blockchain. Similarly to Lunk, Zilliqa's announcement has created a green week for Zil, but it hasn't stopped the longer-term downtrend. Zil also appears to be hovering around the critical zone of long-term support that extends back towards the previous crypto cycle. If it breaks below these levels, it may sink to new lows. Note that you can find out which crypto projects are pumping in real time and where you can trade them on the Coin Bureau Telegram channel. The link will be down in the description.
And that's all for today's Coin Bureau Weekly Crypto Review.
If you enjoyed it, then you know what to do. Hit that like button, subscribe button, and bell icon too.
Don't forget to check out our deals page where we have massive discounts and airdrop bonuses of up to $40,000 on some of the best exchanges, only for the viewers of this channel.
You can find the link to that resource and many others in the description below.
Thank you so much for watching, and we'll see you all in next week's episode.